time horizon is really, really crucial. So that, the journey is just quite bumpy, basically.
So if you have a short time horizon and you know that, what is like a solid approach to your solid take, I guess, to have with your portfolio?
So there are ways of doing what is called de-risking a portfolio, so reducing the risk a bit. So obviously the most the thing that has less risk is cash, as you can imagine. So if you have a very short time horizon, then investing is not for you, and you just keep your money in cash. But if the time horizon gets a bit longer, but you don't want to go fully into stocks, you have another option, which is what is generally referred to as bonds or fixed income.
Okay, and what's the difference between bonds and stocks?
Yeah, very good question. Very crucial difference. So if you are investing in the stock market, what you are effectively doing is buying a tiny piece of a listed company. So, say Apple or Microsoft, they're listing on the US stock market, and you're purchasing a small bit of it. The bond market is a little different, because a bond is a financial instrument that governments and companies use to borrow money from investors. So you're not buying a piece of the company, you're kind of just lending the company some money. So what happens is that at the end of the length of the period, the company or government pays the money back. And in the meantime, you receive an interest rate. Now, bonds are also on a market, so they have a price, they get bought and sold. But the basic principle is that this is way less volatile than the stock market.